Are there conditions in place in today's market that remind you of that 87 crash? And do you think we could be on the precipice of something like that happening? I'm calling out record high valuations. I see Tesla up 8, 9 days in a row for really no apparent news. Nvidia over a $3 trillion market cap. To me, it feels like an expensive market that doesn't deserve to trade where it's trading at.
Yeah, and that valuation does matter, as I've mentioned, but I also think it's about, ultimately, it's a macroeconomic trigger that makes people aware of that the market is or was too expensive. And then the realization sets in, you have to get out of these expensive names. Lots of comparisons have been made between NVIDIA, let's say, and Cisco in the 90s as an example, which are two very different companies. And it just generally the idea of like where AI is versus the internet time, the startup internet period in the late 90s. There's definitely some level of froth is there. There's a lot of liquidity in the market. You see speculation through this the sector called meme stocks, right? That's happening. We know that volatility may be on the lower end of the historical range. If you read again, boring report perhaps, but the monetary policy report from the Fed has always some interesting nuggets in there. There's a whole section about financial stability. One thing that stood out to me is they're making, again, a reference to what the hedge funds are doing. They have more leverage on than they had several years ago. They have this huge, what they call basis trade on, which is like playing basically the treasury futures versus treasury bonds. That seems to be a massive trade. I think if I think of that, for example, as a former trader and PM, when I was really involved in that type of trades, those are like very murky areas, that are unknown how exactly it's going to unwind. I think also the Japanese yen is another example in that context. Yen is at the weakest level in almost 40 years. And the yen is always used as a borrowing mechanism for taking risky bets in other assets. It's called the yen carry trade, the technical term. How that's going to unwind against this valuation issue that we're seeing in the stock market, which could get even richer, by the way. It could be even more expensive before it actually unwinds. So I do agree that the 1987 analogy, maybe to an extent there. We obviously have high frequency trading and algorithms and other issues today that could trigger that really quickly. That's happened before, flash crashes and that sort of thing. But at the end of the day, it's a macroeconomic reason why it all unwinds. And to our earlier discussion, what's the risk to the economy from here, right? That deficit, the tariffs, the different combination of these policies ultimately trigger an effect in the economy that's negative. That's what we're actually waiting for, and we're not seeing that yet until it does. And people watch jobless claims, and the unemployment rate as a one reason to be careful. Like if it goes up too quick, too fast, the economy is flipping on its back, right? And then the trigger is there, and all the unwinds start to happen. So I think as an investor, you would look at these risks as they're on the list. We know what they're to an extent about. On the other hand, you just got to invest today, right? And what's the opportunity? Well, the market is in a good spirit, so you should invest, not be sidelined.